So financial statement analysis, very, very quickly, it's important. And why it's important? Because everybody wants to do something with the other companies, especially these days. I'm talking to people, right, who want to invest right now. The market is going down. Everybody is thinking about investing. So when you start investing, you always is going to look at some ratio analysis. They're always in numbers. They're always expressed by the percentage. That means we're talking about the ratios. Why do we need those ratio analysis? Again, as you can see, for the two purposes, for the purpose of the investors and for the purpose of the lenders or creditors. So what the investor looking for, obviously they're looking for dividend, or they're looking for increasing the market value of the share and easily cashing some fast return and getting out of the market and move on. Where the creditors, they're looking for interest and ability of the company to pay their principal. So for that reason, we're going to have a deeper type of analysis. So the financial statement analysis technically is not part of the financial statements. It's going to be separate. That's a separate information which is provided by the analyzers and some statistical people who like statistics and who like to compare the numbers. That percentage is not going to be shown on the financial statements, but from the financial statements, we're going to use the information in order to prepare the financial ratio analysis. We're going to rely on the financial statements and notes. We're going to compare, we're going to have comparative information from year to year. We're going to have the auditor reports, which is going to tell us, because if we're doing, obviously, if we want to invest in the company, you have to buy the share of the company, which share automatically bring you to the idea that those shares has to be publicly traded, which means that has to be publicly traded company, which also means that all the publicly accountable enterprises are required to have audit. So for that reason, we're going to look at this audit report. Then we're going to have this management discussion and analysis, which is very common these days, which is kind of management, and there will be separate management report. There might be separate management report, which are going to explain mission, vision, goal, strategy, how the company performing on the short term, long term, which is the strength, weakness, opportunity, all the other things. And the last one will be financial, some non-financial information about the company. We're going to use all this information. So what kind of analysis we can have? We can have horizontal analysis, which will be comparison of the performance of the company by itself. So we're going to look at the how the company moving from one year to another year to another year to another year. That's horizontal analysis. Vertical analysis will going to help us to compare different companies. But before we do that, we have to move to the common financial statement. And then we can, and the last thing is the financial ratios. So the horizontal, we already talked about horizontal. Again, we're choosing 1 year as a base year, which is 100%, and then expressing everything based on that year. And we're seeing what's happened with the company. In this case, we can talk about trend analysis, but the trend analysis, you need at least three years. You cannot talk about trend when you have 2 years. 2 years, we have differences. 3 years and more than 3 years, we have a trend. Keep that in mind, that's from the statistics. Then we move to vertical analysis. The vertical analysis we needed for the comparing different companies. How we're going to do this? One of the elements of the statements, depends which statement, one of the elements, usually the highest number, if you put it that way, will be 100%. And from that number, we're going to find how much of that number transferred to the other numbers. For example, for the income statement, our 100% will be sales. And after that, because you know the income statement starts with the highest number, which is sales, and after that, deductions, and at the end, whatever left. So technically, we're chasing for every dollar of sales, how much is the cost of goods sold, how much is the operating expenses, how much is the gross margin, how much is the net income for every dollar of sales, how much left as a net income. On the balance sheet, we're going to get again the highest number. Which is the highest number? Well, the total assets is the highest number, which magically is equal to the total liability and equity. As you can see, remember, the basic accounting equation, assets is equal to liability plus equity. So the total asset on one side is the highest number, on the other side is exactly the same number because those have to be equal. And then we start expressing how much is this asset compared to the total asset as a percentage, and we're going this. And then we're going how much is the liability as a percentage of the now total liability equity. In other words, compared to the total assets. Because again, total assets is equal to the total liability and equity. So how much is the liability, a percentage of liability. That's how we're gonna talk about of the financial leverage. That will be another thing which is interesting, financial leverage, which financial leverage is because on one side you have the assets, on the other side you have liability and equity. How the changes in liability and equity compared to the total capital. That's another thing that's interesting. So again, we're going to express the sales as 100%. We're going to start comparing the percent, expressing the percentage of every element on the income statement. For the balance sheet, again, we're getting the total assets is the 100%, and we're expressing the other element of the assets as a percentage of the total. Same thing with the liability and equity, which will be equal to the total liability equity, which again magically is equal to the total assets when expressing the numbers. That's how we're going to see how much is the debt and versus equity ratio compared to the total. Then we're going to the common size financial statement. Again, common size financial statement is everything expressed as a percentage. That's how we can compare different companies which has nothing to do with each other. That's how the investors now comparing. They're seeing that what you can see is you don't care technically, I mean, how much assets one company has, how much the other assets the other company has, do you? But you care about what's the return on investment. In this, if I invest $5, how much will be my return? If I invest $5 in the other company, how much is going to be my return? And everything is expressed as a percentage. Benchmarking, obviously, benchmarking will be you choosing the best companies in the industry or best industry company in the world as top, and then you start comparing all the other companies based on that company. Obviously, it's not fair you to compare oil company to the Coca-Cola. Right, that you cannot get. If I'm an oil industry, my benchmarking is not going to be Coca-Cola for the financial performance in the oil industry. I can compare myself to Coca-Cola when it comes to implementation of strategy and implementation of the mission and vision. I can do that, but that's on the different level. That we're talking about the management accounting. We're not talking about financial accounting. But if I compare, again, choosing the benchmark from different industry, that's not usually works. That's how we're coming with this benchmarking idea. Then we're going to go with the standard ratio analysis, which is going to have different using different ratio to make a decision. Again, all depends on what you're looking for. Are you looking to invest? Are you looking to lend the money? Or what exactly you're looking for? few things that we need to understand as we talked last time. Working capital. What's the working capital? Now, from the cash flow statement, we already know what's the working capital. Working capital in any capital which is involved in the operating activities in the company or operating activities in the cash flow statement, which is the current assets and current liability. That's your working capital. Through that working capital, you'll be able to generate sales, which sales are going to give you some return. So the working capital is simply express current assets minus current liability. And from there, you can get the current ratio and asset test ratio. Current ratio, testing only what's the amount of the current assets versus amount of current liability. How many times I have the current assets in the current liability? More you have it, better for you. If in order to be 1, that means if the current ratio is 1, that means the current assets is equal to current liability. Is that good for the company? At least it's not bad. Let's put it this way. It's not the best, it's not super good, but it's not bad to have current assets to match in the current liability. And as long as you keep it that way during period over period, you're matching your liabilities. Obviously, everybody wants to improve it to make it better. Now, that's with the current ratio. Now, how many of you thinking about seriously thinking about being accountants? I know a few of you who are seriously thinking about being accountants, but how many of you are literally thinking to be accountants? So then watch this. It's something very, 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 very interesting thing. And I want you to know now, this thing now, because that's gonna help you later. Financial ratios are interesting thing. Who looking at those financial ratios? Again, people outside of the company. That's why we're preparing financial statements for the people outside of the company. Financial ratios going to be crucial when it comes to the investors and comes to the lenders. Who will be the one who willing to lend the company money? That most likely will be the bank. So the bank usually always cares about current ratio. So what that means, again, let's see, let me increase this one here. Let's make it bigger. So bank usually care about this current ratio. And current ratio, they want to make sure that the current ratio, now the current ratio, as we already said, is simply, let's merge those two. Let's merge those two, and that it's equal to current assets versus current liability. Versus current liability. That's simply the formula here. There's nothing else, nothing hidden, nothing scary, nothing unknown. Current assets versus current liability. Now, when this is going to be equal to 1, this is going to be equal to 1 only and only when the current asset is literally equal, when the current assets is equal to current liability. Then the current ratio is equal to 1. That totally makes sense. That's a simple formula, simple equation, nothing here, nothing else. Now, one thing that I want you to know though, so watch this, if the current ratio is more than 1, not question mark, more than 1, if you reduce the current assets, if you use the current assets to pay current liability, that's going to improve the current ratio. And if the current ratio is below 1, is less than 1, if using the same technique, getting the current assets to reduce the current liability, that's going to make it worse. Current ratio. So let's test this one. This is a concept. I'm telling you this one in the financial ratio analysis, which is 1210 course here in Douglas College. But where you can see this idea, you can see it in the finance courses. You will see it in the finance module in the CPA. You will see it on the CPA Core 1 exam. You see it on the multiple choice question exam. You can see it in the Core 1. You can see it on you may even see it on the CFE. For those of you who's going to go with the accounting. So you better know it now rather than later. So let's do some math. Imagine my current assets are 200 and my current liability are, let's say, 100. 120. Let's go with 120. Okay. So what that means? That doesn't means that the current ratio will be somewhere. Let's see what's the current ratio here. If we have to get the formula for the current ratio is going to be, here we're going to have a numerator, we're going to have 200. Denominator will be, sorry, that will be this one. I'm too fast on the moving. This one, that will be 120. And so my current ratio in this case simply is going to be, let's merge those two, is going to be 200 divided by 120. So my current ratio is 167. Now the question is my current ratio above 1? Yes, it is. So if the bank wants me, doesn't like this ratio, and ask me, can you improve this ratio? Your answer always going to be yes, I can improve it. How? Well, simply use the current cash to pay the accounts payables. You can literally write a check and pay the accounts payables. So let's see if this is going to work. So we're reducing, now let's say we're using current assets for $50. For $50, sorry, not 80, $50. And we're reducing the current liability with $50 with exactly the same amount. So where will be my current asset now? Now my current assets will be equal to 200 minus $50. And my current liability will be 120 minus $50. Why I did it this way? Let's do it. Let's do a different way. I want to put here current assets. We're going to reduce it with minus 50 and current liability with minus 50 as well. So I want to use it as a formula so I don't have to calculate it every time. This one plus that one, and then we're going to have this one plus that one. It's going to be here, minus 50 here. So what happened with my current ratio?
Went up.
Went up. So this is a simple thing. If the bank, again, if you are here in this scenario, you are here, year end coming, or the bank or the month end coming, you know the bank monitor your current ratio. And let's say the bank wants your current ratio to be more than 2. What do you have to do? Check where the current ratio is sitting at. If it's above 1, do some calculation here. See which will be the amount that you can use from the cash to close the current liability, which is going to improve the ratio. That's why I put here minus. So if I go with minus 40, for example, is that going to help me? Yes, it helps me. But I have to give minus 40 here too. Right? Let's do it this way. So if bank wants me to, with $40, I can easily move where the bank wants me to be. If I want to be even better, look good for the bank, I'm going to get $45. That's not going to hurt me as a cash temporarily, but it's going to improve my current ratio. Make sense? This one,
Yes.
this one always works when the current ratio is above 1. Paying with cash current liability always works. Minus, let's say we go minus 80, what's going to happen? You even go to current ratio 3. From 167, you went down to up to 3. And you can do this within the 1 business day. So in the morning, you're checking where the current ratio is. You're writing one check for the amount that you're coming with, closing that payable, and you improving current ratio. Just like that. Now let's see if this one is the scenario when improves the current ratio. Now let's see what's going to happen with if this actually works. Because if we said if the current ratio is below 1, make it worse. I'm going to copy this since we already have it. I'm going to paste it here. And let's get rid of this formatting because we don't know if that's actually true yet. But let's check the numbers. Now, imagine now the current assets are 200 and my current liabilities are, in this case, are $220. Now my ratio is below 1. Can you see it?
Yeah.
Now, if I reduce my current assets with, if I use $100 cash to pay current liability for cash, my current asset is going to go down to 100. My current liability is going to go to 120, but my current ratio get worse. Can you see it? So for that reason, it's very important you to understand where you are. If you're in the first scenario, yes, use the cash to improve your current ratio. If that's not the case, if the current ratio is below 1, find another way. There's always another way. What you need current assets. From where you're going to get it? Well, you have to study more accounting you to get those ideas. At the end of the day, don't forget, we're dealing with the investors and we're dealing with the banks, which are very sensitive to the ratios. Bank may not understand anything about the business, but they know the ratios and they have a textbook. If the ratio doesn't meet this, I'm not going to give you money. If that ratio doesn't meet that, I'm not going to give you that money. So that's where the accountant comes. Can you ask artificial intelligence to do that? That will be the question one day. And if artificial intelligence sense this, can the artificial intelligence tell you right away what to do?
All right. So once you get into
Yes.
here, it's not going to let me. You have to delete that entry. I could also check, is the date right?
Is that for me or no? I don't think. Is it for us? Or just somebody just left his mic?
I don't think so.
To build a customer, no different.
Okay.
Not enough memory. Oh, you see, this is the problem. Okay. It's going to kick me out.
Okay. So this is something else. Sorry about that. That's gonna stay on the recording. Unfortunately, let's go back to slides now. And now that's what I wanted you to know about the current ratio. Let's go to share my screen and the ratios, and let's keep going with the ratios. The next ratio is the quick ratio. On the quick ratio shows the ability of the company to pay the current liability again, but with the most liquid assets. Which are the most liquid assets? Cash, cash equivalent, accounts receivables. We're gonna eliminate the inventory and we're gonna eliminate prepaid expenses. Those are not part of quick cash. So that will be asset ratio or quick ratio. That ratio can fall below 1. That's okay. It's not a big concern if that ratio falls below 1. Now, ability to sell inventory and collect the accounts receivables, we're going to get the inventory turnover, accounts receivable turnover, and days sales in receivables, and how many days take you to convert the inventory. So how are we going to get this? Inventory turnover will be cost of goods sold divided by the average inventory. Average inventory, always we're going to get at the beginning inventory minus plus the ending inventory divided by 2. That ratio is going to tell you how many times you are able to sell your inventory. Now, depends on the business. So can we say that 2.7 times is a bad ratio? Depends on the business. It all depends on the business. Imagine I'm the company that's selling high, unique heavy duty constructions vehicle, crane, some other, which is very, very how can I say, specifically needed. If my inventory ratio in this case, inventory turnover is 2.7, is that good for me or bad for me? What do you think? I would say if my inventory is 2.7, that's a very good inventory turnover ratio. Why is that? Because it's heavy construction equipment. If I'm selling like a 2 crane, which we have the capacity to, which have the ability to lift 500 tons equipment, I'm doing very good. But if I'm in the flower business and my inventory turnover is 2.7, I'm in big trouble. I'm literally in big trouble. That means how many days is going to take me to sell my inventory? If you get 365 divided by 2.7, you're going to see this. How many times? So the worst one will be what means if the inventory turnover is 1. That means you're able to sell your inventory only once a year. So that means the days that inventory stays in your warehouse is 365. So where you want it as high as possible. So where do you want your days in inventory in the flower business? No more than 7 days, especially if you're selling cut flowers. On the grocery store, yeah, you can extend it a little bit more. Accounts receivables turnover, same idea. But here we're dealing only with the net credit sales. We're not dealing with the total sales. We need dealing with the net credit sales because only the net credit sales are related to accounts receivables. So we're getting the average accounts receivables, which is beginning plus the ending divided by 2. And we get the net credit sales for the year. And we're seeing the accounts receivables turnover. If the accounts receivable turnover is 1, that means I'm collecting my accounts receivable only once. So that means that my accounts receivables are outstanding for 365 days. So where they want the number high as possible here, because that's going to reduce the day of the accounts receivables staying outside. Now, based on the nature of the business, 30 days, that's considered good if you're working on credit. 45 days, still not bad. 60 days, it's okay. I would say it's okay. 125 days, now it's getting worse. So that will be the one. What else? Next one is the ability to pay the long-term debt. How are we going to see this? We're going to check 2 ratios here. We're going to check first debt ratio. And after that, or exactly after that, we're going to check the time earned ratio. So what's interesting with those ratios? First one, how are we going to get the debt ratio? Obviously, total liability divided by the total assets. Why the total assets in this case? Because always remember, total assets is equal to total liability plus total equity. Can I modify this formula? Absolutely. I can do debt ratio is equal to the total liability divided by total liability plus total equity, which magically is equal to the total assets. Make sense? So you're checking what's the percentage of debt, and that's all. Now, another thing that I want you to understand is, let's go back to the Excel spreadsheet, because on the debt ratio, there's a lot of things that going on in the CPA again for the debt to equity ratio. Debt to equity ratio, right? That's what we're chasing. Now, sometimes the question says this: debt versus equity is in relation 2 to 3. In a proportion 2 to 3. Then the question is 2. No, let's go with this one. 2 to 3. Then the next question is, how much is the total assets and how much is the total liability? No, I mean, you cannot get the total assets, obviously, total assets will be 100%. But the question is, what's the percentage of the debt and what's the percentage of the equity? In this ratio. In this proportion here. What is going to say? Do you know how to calculate it? That's my question here. Are you guys with me?
Yes.
So, what's the percentage of debt? What's the percentage of equity? Proportion is 2 to 3. Do you remember the partnership? When we have two partners and they sharing the gain and losses in proportion 1 to 5 to 7. How are we going to get the percentages?
2 divided by 3.
Okay, let's do this. So you're saying here 2 divided by 3. 2 divided by 3. What are we going to get? And the other one will be 3 divided by 2.
Yeah.
Let's see, equal 3 divided by 2. What's the case? We're chasing to get 100% here.
Yeah.
Did we get 100%?
No.
No. So that doesn't work.
No, it's 2 plus 3, it's 5.
Okay,
So
so
2 divided by 5 and 3.
okay, let's go 2 divided by 5
And 3
and
divided by 5.
3 divided by 5 equal 3 divided by 5. Oops, not that one. No,
That's 100%.
3 divided by 5. That's 100%.
Yes.
Yes. Don't forget that, please. Bottom line is don't forget that. Because you usually tend to forget. Two plus 3 is equal to 5, and then get the percentages. 2/5 and 3/5, and you're getting the 100%. And then you can work with the numbers and go from here, whatever you want to do. Okay, that's another thing that I wanted to show you. Let's go back to the slides. So now the debt to total liability divided by total assets is going to give you the percentage of debt. Once you have the percentage of debt, you can easily calculate how much is the percentage of equity. Now, once we do that, the next thing that we have to calculate is the time interest on ratio. How are we going to get this? We're going to get the net income from operation, but we're going to include in that net income from operation means our net income plus interest expense plus income tax expense divided by the interest expense. So what we're comparing is how much is the income that I'm generating and how much I have income that I'm generating, including the interest expense, including the income tax expense versus the interest expense only, or how many times I have the income in the, or how many times I have the interest expense into my income. This way, just put it this way. So what that means, how many times I can pay my interest expense with my net income, my income from operations. That would be another way to say it. Simple example will be this. I have to go back to the Excel spreadsheet to show you the simple example here. Let me find this Excel spreadsheet because it doesn't show it to me. Okay, that will be this one. So imagine my debt is 40%, my equity is 60%. My net income, net operating income, let's say my net operating income is 60,000. And my interest expense is, let's say, 20,000. So what that means? That simply means that this 40% debt that you have, for the 40% debt that you have from the total assets, you're paying $20,000. And with the income that you're generating, you're able to pay that expenses 3 times. So now the question is, what if I increase my debt? Can I increase my debt? Well, what's going to happen? Let's say if I increase my debt to 50%, my equity is going to be 50%, right? Because I have to be 100 here. Now, if that gives me increase in my net income with $40,000, but increase my interest expense with $10,000, so I go with the 30,000, do I have to worry about adding additional debt in my company?
No.
No. That's one thing I want you to understand. It's a very interesting concept. So basically, if you borrow $100,000 from the bank and you're paying 10%, that means bank wants you to pay them $10,000. Correct? Let's say you borrow cash from the bank, $100,000. Bank want to pay them. The bank want to charge you interest. Is 10%. That's how much bank they want. So, where is your interest expense here? $10,000. Make sense? My interest expense is $10,000. Now the question is, with this cash that I borrow, how much operating income I can generate, including the interest expense? Make sense? So if you have a good idea, which brings you 20,000 cash, including the interest expense, do you have to worry about it? No, because what you can do with $20,000, you can pay the bank the $10,000 interest, and you're gonna still have 10,000 sitting in your possession. Make sense? You're earning more than 10% interest. But if this ratio going down, then you're in trouble. So if this ratio, if we borrow another 10,000, let's say, and we borrow another $10,000, sorry, another $100,000, now I have $200,000, and still paying 10%. That means I have to pay the bank 20,000. But now my operating income, net operating income, jumped to $60,000. Is it good for me that I borrow more money? What you gonna say? Is it good for the company that borrows more money now? Borrow another $100,000? Yes, interest expense obviously double, but what's happened with the income in this case? It went more than double. So basically, how you can see this, how you can interpret this, is that the company has ability to generate income. The fact that increasing the debt at this case is not a problem for the company, because company is still generating enough income to cover the interest expense and to have income staying with for distribution to the shareholders. So the debt here in this case is not concerned. Same thing we're going to see here with this example from the slides, where the company debt increasing from here from 0.51% go to 0.54 go to 51%, go to 55. So they're adding additional debt here, but the time earn ratio from 2.79 went to 3.62. As long as you're seeing that trend, simply means that it might means that they found cheap debt for which they don't have to pay too much. But they have interesting going on in operation, which they're generating more than they're paying for the interest expense. So borrowing for this company is not a problem at this point. But again, always look at those ratios together.
Excuse me.
Yes.
Are you sharing your screen?
Am I? I don't know.
No, I didn't see anything.
No? Okay. So again, this company, debt, as you can see, from 51% went to 55%. So they're increasing the debt. But at the same time, interest earn ratio also increasing. That means the company has ability to pay the debt plus generating more income. So for this company, adding more debt is not a problem. But you always have to look again, you always have to look those ratios together. And don't get scared right away if you see the company adding more debt. Check the ability to generate income with the additional borrowing that they're doing. Now, the measuring profitability. On the profitability, we're going to have rate of return on the net sales, rate of return on the total assets, return on the common shareholders' equity, and earnings per share. Now, first one is rate of return on the net sales. Will be net income divided by the net sales, and we're going to see the ratio, how much of the net income stays in the company. How much of the sales in the sales stays in the company. So you can see they're improving from 3.2% to 5.6%. That's definitely is improvement on the right direction. The next thing that we can see is the rate of return on the total assets. We're going to have the net income plus the interest expense. Interest expense is always added to the net income, but not the income taxes here. As you can see, divided by the average operating total assets. So you can see this is more like for the investors, they to see with the assets how much return the company generates for them. In this case, they're generating from 7.8% return to 11.3% return. Rate of return on the common shareholders' equity of these assets, how much is directly and related to the shareholders. That will be the net income minus preferred dividend, if that's a preferred share, divided by average common shares equity. That's not weighted average, it's just average common shares equity, and we're getting that one. And the last thing will be earnings per share. Earnings per share. Now, for the earnings per share, we need the weighted average number of common shares outstanding. That will be the only tricky part here. And we're going to see that we're going to get the net income minus the preferred dividend divided by the average weighted average number of common shares. Now, can I compare earnings per share from one company with another company? That's usually is not going to be a good thing. And you can invest because one company has higher earnings per share. That's not necessarily a right decision. Why? Because you don't know what's the weighted average number of common shares outstanding. What if the other earnings per share is higher only because they have 10 outstanding shares, and the other one have $4.60 earnings per share, but they have only 100 outstanding shares, where the other have $3.50, but they have 2 million shares outstanding. again, we're not comparing earnings per share, and you're not judging the companies based on the earnings per share. You're just seeing how much of the income belongs to the share as a dollar amount. That's all. What are you going to say about this one? Which one of those ratio measures profitability except the current ratio, right? Current ratio measure the liquidity. Okay, that's with that. Analyzing shares in investments. Now we have a dividend and we're gonna gain when the shares are sold. Now the dividend is ability to get a dividend. Now for the dividends, what we have to see is price earning shares. So that will be the market price per common shares divided by the earnings shares, and that's going to give you the price earnings ratio. That will be the expected earnings for that particular shares, which is very subjective because the market price per common shares is very subjective based on a lot of things and based on the fluctuation based on the everyday market. So that's earnings price earning ratio is going to change day per day. Same thing with the dividend yield on the common shares. We're going to have a dividend per common share versus the market price per common shares, which also fluctuating. For the share investment, the book value for the common share, we're going to get the book value per common share. That will be the total shareholders' equity minus preferred share divided by the number of the common shares outstanding. But that will be only for the calculation of the, again, book value, which has no relationship to the market value on whatsoever. What's a limitation? Limitation is ratio may indicate something wrong, but not specifically what is wrong on how to correct it. So basically, again, the ratio just give you a sign. It's more like a map of the symptoms. What's the source? You have to dig deeper. How can you dig deeper when you know what the ratio measures and what's the obviously numerator, what's the denominator, what is included in the numerator, what's included in the denominator, and you're going to go element by element by element in order to find out where the problem is. That's how we're using those ratios. And the limitation, again, the other one is what if the current ratio has decreased significantly? If is it the best to analyze the component of the ratio in order to identify the cost of the change of the ratio? So again, the current ratio, be careful with the current ratio. You might have to face it in your life and to find out what's happening with the current ratio, because the current ratio is chased by the banks. Non-financial data, obviously, we have to look at those financial data in order to make intelligent decisions when you're investing the money. That will be the president letter to the shareholder, management discussion and analysis, audit reports and management reports to the shareholders. What we can look is the change in sales, earning problems, decrease cash flow, too much debt, inability to collect receivables, increase in the inventory. Those are always something that you should look very closely before you decide to invest and do anything with that. International Financial Reporting Standards, you're going to see, for those of you who's going to continue with accounting, they're going to see the International Financial Reporting Standards and what exactly happening there. For the rest, with the people who's not continuing with accounting, you are pretty much done with accounting. For the people who's going to continue, there will be a new learning for you in the next accounting courses. For this course, we are officially done.